is that the market, and let me go ahead and just change this a little bit. I want to make this a little bit bigger, and I'm going to make this green, and I'm going to call this the market value. Okay, that's the market value, and it went straight up. And then we have, and I'm going to make this a dotted line, then we have the assessed value. Okay, and I'm going to abbreviate that by calling the ASSD. You thought I was going to stop. You thought I wasn't going to add the D to it. I know you did. That's going to be the assessed, not the value. I'm not from Louisiana, but the value. All right, the assessed value. And why is it that the assessed value, the dotted line, isn't keeping up with the market value? Well, the reason why is because of what's called the 10 per, I want this to be a little bit lower. Now, actually, you know what? I want it here. I want to move this here. And this is the 10% cap. Right? This is the homestead 10% cap that prevents my assessed value from the market value. Now, here's the thing. We're going to do one of these, and then we're going to say, let me move this here, and we're going to say that this was all the way to, I'm going to grab this. I'm going to say that this was the 2021. 2021 market value, right, peaked right there. So now this is what I'm going to do. I'm going to grab another little line, and I'm going to go down. And I'm going to make this line red because green means prices go up, red means prices go down. And we're going to call this the 2022 market value. Well, you know what's happened? My assessed value still went up. Why? Because I make up the gap. So my assessed value still went up by what? By 10%. Because I'm still under the market value. My assessed value is not going to stop going up until these two lines meet. Okay, so let me just say this is 2022, and then I'm going to grab another line, and I'm going to make it purple, and I'm going to say this is 2023. Well, guess what's going to happen to my assessed value? It's going to go up by 10% because I'm still under the market value. So yeah, my taxes are going to go up 10% this year, 10% next year, probably 10% the year after that, even though the market value is going down. Does that make sense, you all? Does that make sense?
Yeah.
Yes, Melanie
So
Price.
it makes sense, but I have two properties. They're investment properties and they're not capped. And even though, so one of them, the assessed value went up a lot, but my mortgage payment only went up like $40. And then the
Mm.
other one, it only went up a little bit, which technically would be market value, but of course I'm going to protest. And that one went up by $200. So I actually reached out to the mortgage company and I was like, hey, so you're showing that my taxes are the same, my insurance is going to be the same. So why did you go up on my payment? And they told me that I can protest my escrow analysis.
Yes.
So what I'm going to do after I protest is I'm going to send them that information. I'm going to send them my homeowner's insurance renewal, and I'm going to make them uh, take that money off because that's ridiculous. But I don't think people know that they can do that.
Yeah, because what they're legally allowed to do is they're legally allowed to get your 12-month taxes divided by 12, multiply it by 14. So that's what they're allowed to do. And they're allowed to do that on your anticipated taxes. So if they say, Well, we expect your taxes to go up. It went up last year by 30%. So we think they're going to go up by maybe 30% again. We're going to get that final amount that we think is going to happen. We're going to divide that by 12, and then we're going to multiply that by 14 because statutorily we're allowed to pad it by that amount. And your point to them is, whoa, wait a second. I already have my preliminary values. My preliminary values state that it actually went down. And I would say that most of them are going to look at that and say, okay, that sounds good. That's fair. You have the values. The values don't get sent to the mortgage company. And of course, the mortgage company, they don't proactively look at the values. They don't, and they shouldn't. So that's where you do have the ability to proactively call them up saying, oh, pause. I already have the values out. It actually went down. So what they could do, Melanie, they could do one of two things. Well, they could do one of three things. Number one, ignore you. Whatever. Nothing changes. That's what they can do. Number two, they could say, well, we understand what you're saying, but the tax rates aren't out. The values are out, but the tax rates aren't out. So we don't know if they reduce the value because they're going to try to collect on the tax rate. We have no idea what your tax rate's going to be. That doesn't come out until September, October. And in that case, they're right. So they're like, we're just going to pause and let's reevaluate this when the actual rates are out. Well, when the rates are out, then your bill is out. So then that basically means nothing changes. Or, of course, the third and final option is either a full acceptance under you countering or a compromise, something in between. But it's, in essence, an acceptance. So those are the three options that would occur. So, and that's in your case where in a lot of folks here own rental properties. Good for you. But take a very, very close look at your escrow balance, at your escrow account. Very, very close look. Very close. Because the other thing is this. If your mortgage company is not being as proactive as Melanie's, and I would even say that Melanie's is being overly proactive, but if your mortgage company is not being proactive, this is the risk that you have. The risk that you have is that you got the 2021 market value, but let's just say that yours actually, instead of going down, it actually goes up one of these, right? But then your escrow account stays moving forward. Your escrow account is like, oh, well, everything's fine. And let me change this to this. Like this is your escrow account. Oh, everything is perfect. Everything is fine. So they do one of the, oh, you can change that. I love it. So now you've got a gap. Well, you know what's going to happen? This is going to be the bill. We're just going to call this the bill. That's going to be the bill. This is going to be your escrow amount. And there's the gap. And the gap can be, let's just say, $3,000. So next year, come January, March, realistically, they're going to say, hey, we went ahead and paid your taxes. We were expecting your taxes to be $7,000. Or let's just make the numbers round. We were expecting your taxes to be $10,000, and they were $12,000. So we're going to grab the $12,000. Let me get a little calculator here going. I love these conversations, by the way. Let's get a calculator going. They're going to say, we're going to grab the $12,000. We're going to divide that by 12. We're going to multiply that by 14. Right? It's $2,000. So we're going to get your $12,000. We're going to divide that by 12. We're going to then multiply that by 14. That's $14,000. We're going to add the $3,000 delta that you had. That's going to be $17,000. Then we're going to divide that by 12, and this is going to be your new escrow, $1,460. Well, let's write this down. $1,416. That's going to be your new amount, $1,416. Well, what was your old amount? Well, your old amount was $10,000 divided by 12. That was $833. $833 minus $1,416, that's $582. So people are like, whoa, wait a second here. My mortgage payment went up $582. Well, that's because they're covering last year's gap and they're adding the padding that they're legally allowed to add. Now, worst case scenario, this is what they do. They say, whoa, wait a second, your taxes came in not at $10,000, but at $12,000. So we're going to grab the $12,000, and that was a 20% increase. We're going to multiply that by 20%. That's $2,400 plus the $12,000 is $14,400. Now we're going to divide this by 12. Okay, so then we're going to multiply this by 14. That's $16,800. Then we're going to add $3,000 to this. Then we're going to divide this by 12. It's $1,650. You see what they're doing? So now they're like, oh yeah, yours is $1,650 we're going to escrow. And what was your original escrow? Right? So keep that in mind, $1,650. Let's do this now. Let's $1,650. Your original escrow was what? $10,000 divided by 12, $833 minus $1,650 is $833. So we're going to go $1,650 minus $833. Your payment just went up by $817. And they can do that. They can do that. That's how the math works. Okay, so we've got one of mine just went up by $450. Mark said, we just got hit by this. Big ouch. That's what's going on. Now, some banks will say, hey, you owe us $3,000. So instead of your payment going up by $800, pay us the $3,000 that you owe us, and then your payment's going to go up by $500. But what they're doing is they're amortizing the delta throughout the next payment cycle, throughout the next escrow cycle. That's why it's like, well, now your payment went up by $817, but starting next year, your payment's going to go down to $500. Well, because now you wiped away the $3,000 debt. That right there is what happens. Violet says, when does this happen? Whenever you're short. So if they're escrowing for X amount, but the bill comes in higher, that's when that happens. Primarily if it's new construction. This is very popular when it's new construction. Very popular with investment properties because you don't have the 10% cap. But this is very, very common. Very common when the mortgage company does not escrow the necessary amount. So we got a few team price agents that have had this happen to them, but this is the explanation. Does this help you all? Does it help this explanation, doing it this way?